Joe, how would you compare this meeting that's coming up to the one in 2014? Because it's interesting, oil market psychology is, crude had this big move and there was kind of a floor at 80 in the fall of 2014. And, all the speculation was that OPEC's going to come in and cut production. And you look and oil prices are half what they were, and it's 2 years down the road, and there have been all these bankruptcies, and, some of these petrostates are hurting now. I mean, the reaction post-Thanksgiving in 2014 was a 10% move lower. I mean, do you think that psychology, or at least like market sentiment, has shifted quite a bit going into this meeting? I mean, 10%, a 10% move this time around would be pretty large, and it seems like people are skeptical whether anything gets done.
Yeah, I mean, it's important to remember the Saudis were telling people they were not going to cut, and nobody believed them. So I guess it was a surprise. It probably should not have come as a surprise just based on that. But I think the parallels are, it's another big meeting because really, as we said back in the spring, the December meeting is going to be the first time OPEC reconsiders its policy of, market share and no cuts and things like that. And that's what we've seen over the last, couple months. They've actually started engaging a little early with the Algiers meeting. But the point is, now we're coming to some critical times where they're rethinking their policy. Unfortunately, they can't agree. It's like herding cats. They can't get everybody to agree with what's going on here. But I agree with you. If they don't have any kind of credible deal here, they've so built up expectations. I think you could see not just 10%, but a 20% drop in prices. And one of our panelists at the Macrocosm conference, I think, was even more bearish and thought oil could go into the 30s if there's no credible deal.
Well, Schilling was like, he said 10 to 20. So it's like, what's interesting about the bear case on oil, if only it's because one of the only things I haven't screwed up in the last week, is that I love, it's like, give me a bone here, Joe. Like, I'm just, oil was down yesterday. I think I wrote it in a real-time alert. I'm like, I just needed some kind of a win, just anything. I mean, I could have been right on bingo. But the reality is that we're not consensus on bearish oil. The market is consensus being bullish of oil and expecting more and more and more of something that they don't even understand. I mean, as Gary Schilling said, I mean, now I think that on the bear case, the question is, are you bearish enough? I mean, I don't think 10 to 20 is in the cards. If it is, God help most people and the stock market, by the way, because it would light the entire channel of junk bonds and high yield bonds on fire. All these different companies that have allegedly survived due to oil going back to 60. Newsflash, it's at 45. But if you get a 10 to 20% move, never mind getting cut in half, which is effectively what Schilling's looking for, this is going to have massive ramifications to the broader macro market. This is not what people are expecting.
Yeah, I mean, I'm bullish long term, but short term, I just don't see how you end up in a bullish situation here. I mean, I think you're starting to see the market somewhat agree with us. You're seeing a lot of more shorts, people unwinding bets. I think they're really nervous. I think OPEC has really not given a lot of confidence since the Algiers meeting. Now, maybe this Doha development this morning, I think, might get people thinking again that there'll be a deal. But I've actually been surprised. I would have thought some more verbal intervention, like when we met that day at Macrocosm on Wednesday, was the day the inventory numbers came out, and there was a record build in the U.S. It was up 5 million barrels a day. The expectations would be 1 million barrels. And what happened? The Russian oil minister, energy minister, said, "We've agreed to freeze," and the market quickly rebounded based on that. So Bloomberg had a great story that all the Russian verbal intervention has added about $6 billion to their official currency reserves.
Well, I think, it's perfect for, and I will take some questions from the audience because I know they have some questions for you, Joe, but it's perfect for firms like us because A, we have a research team, B, we have you on it, and then C, we have a quantitative signal. Because what you have are basically a lot of people who don't have any research context at all. Like, they actually don't even know the history of OPEC, never mind the history of said production cuts and what it's actually meant for production in the future. They don't have any contacts in Saudi Arabia. They certainly weren't sitting in Riyadh. It's a dude sitting there in Chicago trading oil futures who's reacting to every headline. That's what they're doing.
Watching CNBC or.
But it's
you're
not
right.
unlike, that's what the old wall is, and that's why it's such a great opportunity for an independent research team like us, you and I teaming up with an actual market signal and levels against those guys. Because from a trend perspective, it's easier to get the bigger moves right. Very difficult, admittedly, for anybody. You and I won't do that because it's impossible to trade every single Russian headline versus that headline and this headline. But to get the intermediate term direction of oil right, provided that you have the catalysts on the calendar right, and what is the most likely scenario coming out of those calendar catalysts, and some ranges, I think I love it. I mean, I've never felt better about trying to trade oil from a trending perspective. So anyway, just
to that point, I mean, just the day after Thanksgiving, when everyone's heading for Black Friday shopping, I'll be getting on an airplane to go to Vienna, because there's early meetings before this meeting where you may get some development. So I think it's important to talk about it. We'll obviously be doing some more macro interviews like this, and of course notes for institutional clients. So we'll be continuing, because it's November 30th. Mark it on your calendar.